If you've tried supply and demand or ICT, yet still struggling to remain consistent, watch this video. I'll be showing you a simple hybrid which fixes the two biggest problems which traders have, which is late entries and bad location. By the end of this video, you'll have a funded account ready playable. Supply and demand will give you location, combine that with ICT, and it will give you timing. And timing is extremely important. As you are aware, there are multiple different trading sessions throughout the day. And as you can see by this chart, the highest amount of volume being put into the market each day is during the London and New York trading session, because as you can see, when the London session and New York session begins in the day, we have the highest amount of volume being put into the market. As you can see by this graph, you can see the huge surges and the spikes of volume being injected into the markets in comparison to when these sessions end. For example, when the Tokyo session begins, as you can see, the volume is inherently lower in comparison to during the London and New York session. And as ICT traders, we want to be trading with volume, which is why time and price is so important. Combining time with price is going to give you precise entries and precise exits. And when you learn how to combine both, this will give you high probability entries with high probability exits in high probability zones. And always remember, your goal is to trade a live funded prop firm account. So therefore, you always want to ensure that you are only risking 1 to 0.5% per trade, as this will help you stick by the rules. And I'm going to show you exactly how I do this. So as you can see, we are now on TradingView, which is what we use to chart. If you haven't watched the last video already, I recommend doing so. And what we can see is we actually have a current bullish trend as the market is making a series of higher highs, pulling back, creating a higher low, expanding up to create another higher high, pulling back, creating a higher low, and expanding up to create another higher high. So what we can see is we actually have a bullish market right now. But what we want to do is mark up the most recent break of structure so we can then identify our trading range, which will give us our premium levels of price and our discount levels of price. And as you are aware, you only want to be selling in premium and buying in discount. So we will now mark up the most recent break of structure onto the upside. And what we can see is now we can now mark up our trading range from this low to this higher high. And what we can see is price is currently in premium as it is residing in the top side of the market. And we can also see we have discount along the bottom. So before being interested in longs, we are going to be interested in shorts, as right now where price stands on the higher time frame is in premium pricing. And this is where shorts are most high probability. But what we can also see is we have an unmitigated level of demand here, which still needs to be mitigated. So when you are looking at supply and demand zones, always look for the most recent created supply or demand zone and make sure you check whether that has been mitigated, because if it has been mitigated, then that means this zone has already been used, and this decreases the probability of this playing out in the future. So for example, now this demand zone is left unmitigated. So therefore, when price does come to this level, we will be expecting a bullish reaction where we can adapt to look at longs because we are then in discount. But as where the market currently stands, we can see price is still yet to mitigate it. So actually we have a clear target onto the downside. So now we have established the current trend of the market and our current bias based off our higher time frame analysis. This chart is the daily chart for those who are unaware. So now we have done our higher time frame analysis, we now drop onto the lower time frames to perform an intraday execution. And this is where we use time and pricing to get a high probability trade within a specific trading session. So we are now on the 15-minute chart, which is a lower time frame. And what we can see is we have the daily higher high, which we recently marked up here. And what we can see since making this higher high is that price has actually declined onto the downside and shifted bearish on our 15-minute time frame, as we've had a market structure shift, as we've now seen this higher low on the 15-minute being shifted as price has closed below it. And I call this an order flow shift because the market's order flow has shifted from bullish on the 15-minute. As you can see, the market came up, made a higher high here, pulled back, created a higher low on the 15-minute, expanded up, created a higher high. And if it was going to continue long from there, it would then react with the demand and continue up to take out this higher high. But what we can see is price has actually declined onto the downside and created a swing low on the 15-minute here, which has caused our order flow to shift bearish, which is our first confirmation to now look at the shorts, which we suggested from the higher time frame, because price is in premium. Remember that. So now we start to mark up our levels of supply, and what we can see is we have a supply zone which was created here, but this has already been used. So this actually decreases the probability of this being used again. So we will not be looking for our trade here. From there, we will be looking for the most recent created supply zone, which hasn't been properly filled in. And what we can see is from this reaction to supply, we actually create another supply zone here, which the market is currently residing in. So we are currently reacting with a supply zone. And what we can also see is we've actually swept a key level of time-based liquidity. If you have not watched our previous videos, please make sure to go back because you will learn all about the Asia session range and how I use it. So make sure you go and watch our previous videos. And what you can see is the Asia range highs have been manipulated with our Asia range lows still left intact. So we've actually swept a key level of time-based liquidity, which could then cause a distribution onto the downside to the opposing end of that liquidity, which would be in this case the Asia range lows. So this is why we are now more interested in shorts. Again, this is further confirmation because everything is aligning for us to actually go short for the day. And if you have watched the previous videos, you will understand that on a classical sell day, ideally we like to see the Asia range highs being manipulated first, which is then we will jump onto our lower time frame and look for a lower time frame execution. And now to increase the probability of this trade idea, we will drop even further onto a lower time frame, doing our top down analysis to actually confirm an overall setup, so we can get a precise entry location and a precise exit location. So again, I am now on the lower time frame. I've dropped to the 5-minute chart to actually get an entry point, and what we can see is prices gave us further confirmation, as once we swept the Asia highs, it was actually sweeping a higher high on the 5-minute also, which means this was our higher low. And what we can see is price has actually wicked this, so it's just swept the higher low, confirming that price is intending to go onto the downside, as we have now caused another order flow shift on the lower time frame, which is further confirming this setup. So now we have had an order flow shift on the 5-minute time frame, further confirming our short bias. We can now look at an entry from the most recently created supply zone or displacement, meaning fair value gap. And what we can see is we have this 5-minute order block, which was recently created, which caused the 5-minute order flow shift. And this is our ideal entry point. But I'm not going to refine it right to the order block, because sometimes when you're trying to be too perfect with your entries and exits, you can actually over refine your entry, for example, and actually miss out on a trade setup. So in this case, I'll actually use the pivot in price, because there's not a massive drastic change in my risk to reward ratio from doing this, as we are on the lower time frame. So I'll put my short position at this newly created supply zone with my stop loss just above the high, and then my take profit at Asia range lows, which would give me a 2.6% trade setup. Or if I wanted to, I could actually carry the trade further down into the higher time frame unmitigated demand zone, which we identified on the higher time frame chart. And in this case, we will show you that you can do that. And one very important note to make here is the fact we are now going into the London trading session, which is where the most amount of volume will be injected into the market for the day. And as I mentioned previously, we want to be trading with that volume because we know that institutional orders are being made during these sessions. So essentially, we are now combining time with price. So we are actually now waiting for the London session to approach, which is when we will look to enter our trade setup. As you can see by the timestamp at the bottom of my chart, it is now 7 a.m., which is when the London trading session is opening. So we can now expect that volume to begin pouring into the market. And of course, how will it pour into the market? We will see that visually on the lower time frame, because all big moves actually begin on the lower time frame, which is why we use the lower time frames to actually execute, so we can actually get in at the very top or at the very bottom of these moves. So I will now play price, and you will see we get tapped into the trade at this level of supply, and then from there the London trading session provides the volume which we need to send us onto the downside and distribute us towards our take profit. So as you can see, combining time with price, with supply and demand and liquidity is very crucial to give you high probability setups within the market. And as you can see on the hourly chart, if we was to target this hourly fair value gap, we would have actually achieved an 8.34% on our funded accounts. So as you can see, you do not need to be risking large amounts. If you just risk 1% or even 0.5% on this trade, this is going to make you well enough on a funded account. A huge mistake which many traders make is marking up every fair value gap and treating it as a zone to trade away from, which only results in over trading and a lot of losses. So as you can see on this 5-minute chart here, we have 1, 2, 3, 4 fair value gaps to trade away from. Now there's multiple traders which will try and trade away from this fair value gap, expecting a continuation onto the downside from here. Same with this fair value gap, same with this fair value gap, and same with this fair value gap. So if they was to trade away from every single one of them and only one of them worked, they'll take 3 losses before one would actually go their way, if it was to go their way anyway. So how do we actually solve this problem and refine it into one fair value gap? Well, the simple answer is just to go up a time frame, because if you are on a lower time frame, of course price is going to have more displacements between the candlesticks. But if you just go up a time frame, so for example, we're on the 5-minute now. If I was to just go up onto the 15-minute, as you can see, I have now refined all of those fair value gaps into one high probability fair value gap. As this fair value gap is within the premium level of price, it is a large imbalance, so therefore we will know it will need fill-in. And we can also see there's been a large amount of sell orders injected into the market from this level of price. So as you can see, when price comes back to this fair value gap, we can enter from the open with our stop loss just outside of the fair value gap, take an entry as it is in premium pricing, and actually expect the continuation onto the downside from that fair value gap. And this is because there's no more imbalances above, so therefore there's no reason for price to trade above this fair value gap now. Whereas in comparison to the last one, which was the lower time frame one, this 5-minute example, we can see we had 1, 2, 3, 4 examples, and we had 2 examples in premium. So even though price would have been premium in this fair value gap, if we took an entry from this fair value gap, it would have resulted in a loss. So this is why we just refine it to this overall fair value gap. And another common mistake which many traders make is actually entering trades without a sweep of liquidity. And this is why supply and demand does not work alone, because yes, you may get the odd lucky trade where it hits a demand zone and goes your way, but if you are not combining it with liquidity, then you are going to struggle to create high probability entries. So as you can see, if you was to enter from this supply zone, just because it is the newly created supply zone and it has had some sort of move away from it, and we still haven't took this low, expecting a continuation, your stop loss would be hit because price would run all of this liquidity, tap the fair value gap, and then actually, as you can see, go in your direction as we've seen here. So this is why it's so important to understand why we combine supply and demand with liquidity, because if you're just trading away from supply and demand zones alone, yes, you may get the odd trade which actually hits your take profit, but most of them are low probability because you are really just guessing where price will go from. And finally, another huge mistake which traders make is just trading every trading session, trying to trade the London, New York, Sydney, Tokyo session without actually taking into consideration which is the most powerful trading session, which is the most successful trading session with the most amount of volume being put into the market. So for example, as you can see, we have a demand zone which is being created here and a large move being printed onto the upside, and prices then come back to this demand zone and gave a reaction, and therefore many traders will start buying from this level of demand. And this is what we can see here as price keeps reacting to this demand zone. So this represents the amount of buyers stepping into the market at this level of demand. But because it's the Asia trading session, as you can see, there is not enough volume to actually distribute price in the way these traders want it to go. So eventually it will just range around the demand zone and then close below it, hitting your stop loss. So as you can see, price will just accumulate at your level of demand because there's not enough volume in the market present to distribute price onto the upside, and eventually your stop loss is hit outside of that demand zone. And this is why it's so important to combine price with trading sessions, because if there's not enough volume in the market, then the market will just simply consolidate, and you don't want to be trading during consolidations. You want to be trading during the expansion. So therefore you want to be trading when that volume is being put into the market. As we pointed out earlier on in the video, that is inherently during the London session and the New York trading session, as this is when the most amount of money is being injected into the markets. So why this all works, we use premium and discount for our locations to trade away from, and then we actually use our lower time frame entry models, and then combining that with time and price and liquidity concepts is what's going to help you actually get the most precise entries and exits on them lower time frames. And that's how you catch high probability trade positions on a daily basis using the lower time frames, as well as utilizing a strict risk management plan to keep you consistent on your funded account. If you want to see exactly how I combine supply and demand with ICT concepts to identify high probability zones, the next video will break down the exact same approach I use to stay funded and consistent. And if you are serious about gaining a real edge against the market which is backed by real data, then make sure you subscribe so you do not miss out on the next video.